What if I told you that picking a good stock in Canada doesn't have to be complicated? You don't need to spend hours staring at charts, understand every financial term, or follow the latest stock market hype. In this video, I'm going to show you the simple process I use to decide whether a stock is actually worth my money, from what I look at first, to the red flags that can make me walk away. And stay until the end, because I'll show you the one thing I check before buying any stock. Something many beginner investors completely overlook. If you're investing for your future, your retirement, or simply trying to make your money work harder in Canada, this could completely change the way you look at stocks. So let's start with the first question I ask before I even consider buying one. Step 1. Do I understand the business? The first thing I ask is surprisingly simple. Do I actually understand how this company makes money? Before I look at the stock price, the dividend, or what analysts are saying, I want to understand the business. What does the company sell? Who pays it? Why do customers keep coming back? And most importantly, why should this company still be making money 5 or 10 years from now? Think about a business you understand in everyday life. Maybe it's a bank, a grocery store, a telecommunications company, an energy company, or a company that provides products or services people use every month. You don't have to be an industry expert. But if you need a 30-minute explanation just to understand what the company does, that's a warning sign for me. Because if I don't understand the business, I won't understand what could make the investment succeed or fail. And that brings me to the second step. Step 2, is the business actually growing? A great company isn't necessarily a great investment. Why? Because the price you pay matters. But before I even worry about the price, I want to know whether the underlying business is getting stronger. I usually look at 3 things: revenue, earnings, and cash flow. Revenue tells me whether the company is selling more over time. Earnings tell me whether those sales are actually turning into profit. And cash flow helps me understand whether real money is coming into the business. Now, don't make the beginner mistake of looking at just 1 year's numbers. One good year can happen because of a temporary boom. One bad year can happen because of a temporary problem. What I want to see is the bigger picture. Is the company generally moving in the right direction? Is management growing the business? Are profits improving? And is the company generating enough cash to support itself? Because a company can have exciting revenue growth and still be a terrible investment if it constantly needs to borrow money just to survive. Which leads to something I pay very close attention to. Step 3, how much debt does the company have? Debt isn't automatically bad. In fact, many successful companies use debt strategically. The problem is too much debt. Imagine 2 companies that make roughly the same amount of money. Company A has a manageable amount of debt. Company B has enormous debt and has to spend a large portion of its cash just paying interest. Which one has more room to handle a recession? Usually, Company A. That's why I want to understand the company's debt before I buy its stock. I look at things like total debt, cash on hand, interest costs, and whether the company can comfortably service its debt. This becomes especially important when interest rates rise or the economy slows down. A highly indebted company can suddenly look much weaker when borrowing becomes more expensive. And here's something important. Don't compare debt numbers blindly between completely different industries. A bank, a utility, a technology company, and an oil producer can have very different financial structures. The goal isn't to find a magical debt number. The goal is to understand whether the company's debt looks reasonable for that particular business. Now, suppose you found a company with a business you understand, growing revenue, healthy profits, and manageable debt. Are you ready to buy? Not yet. There's one huge question left. Step 4, am I paying too much? This is where many investors get into trouble. They find a fantastic company. They fall in love with the story. And then they buy it at almost any price. But even a great company can become a bad investment if you pay too much. Imagine someone offers to sell you a $10 bill for $50. It's still a real $10 bill. The problem is what you're paying for it. Stocks work the same way. That's why I look at valuation. One metric investors often hear about is the price-to-earnings ratio, or P/E ratio. In simple terms, it compares the company's share price with its earnings per share. But I don't use one number in isolation. Instead, I ask, how does this valuation compare with the company's own history? How does it compare with similar companies? And does the expected future growth actually justify the current price? Because sometimes a stock looks expensive for a good reason. And sometimes a stock looks cheap because the business has serious problems. That's why cheap doesn't automatically mean undervalued. Sometimes cheap is cheap for a reason. Step 5. What makes this company different? Now I ask a question that I think is extremely important. Why can't another company easily take its customers? This is where I look for what investors sometimes call a competitive advantage or economic moat. Maybe the company has a powerful brand. Maybe customers are extremely loyal. Maybe it has a huge distribution network. Maybe switching to a competitor is inconvenient. Maybe it has a strong cost advantage. Or maybe it has technology or intellectual property that competitors can't easily replicate. The exact advantage doesn't matter as much as the principle. I want to know, what protects this company's profits? Because if a company makes huge profits today but 10 competitors can copy its business tomorrow, those profits may not last. And when I'm thinking about investing for the long term, durability matters. Step 6. Who is running the company? A business can have great products and still be poorly managed. So I also pay attention to management. I'm not trying to decide whether the CEO is charismatic. I'm looking at what management actually does with shareholders' money. Are they making sensible investments? Are they taking on unnecessary debt? Are they buying back shares intelligently? Are they issuing new shares constantly and diluting existing shareholders? Are they communicating honestly when things go wrong? And most importantly, do their actions match their promises? Because anyone can say they care about shareholders. The numbers and decisions tell a much better story. Step 7. What are the biggest risks? This is one of my favorite parts of the process because I deliberately try to prove myself wrong. Instead of asking, why should I buy this stock? I ask, why could this investment fail? What if revenue falls? What if margins shrink? What if a competitor takes market share? What if regulations change? What if interest rates stay high? What if the company's biggest product stops selling? What if management makes a major mistake? You don't need to predict every possible problem. You simply need to understand the major risks before putting your money into the company. And if I can't explain the biggest risks in simple language, I'm probably not ready to invest. The red flags that make me walk away. Now let's talk about the things that can make me stop researching a stock completely. Red flag number 1. A business model I don't understand. Number 2. Consistently weak or deteriorating financials. Number 3. Debt that looks difficult to manage. Number 4. A stock price that assumes everything will go perfectly. And number 5. A story that's much more exciting than the actual numbers. This last one is especially dangerous. Because the stock market is full of exciting stories. This company is going to change the world. This stock is going to explode. This is the next big thing. Maybe. But I don't want to buy a prediction. I want to buy a business. The one thing I check before buying. And now we come to the question I promised you at the beginning. What's the one thing I check before buying any stock? It's this. Can I explain why I want to own this company in a few simple sentences? ***. Not why I think the stock price will go up next month. Not because someone on social media recommended it. Not because the dividend looks attractive. I want to be able to say, I understand what this company does. I understand how it makes money. I understand the major risks. I believe the business can remain valuable for years. And I believe the price I'm paying is reasonable compared with what I'm getting. If I can't explain that clearly, I don't feel ready to invest. And this simple test can save you from a lot of emotional decisions. A simple example. Let's imagine I'm researching a fictional Canadian company. Let's call it Maple Company. I start with the business. I understand what it sells and who its customers are. Good. Next, I look at revenue and earnings. I want to see whether the business has been growing over multiple years, rather than relying on one unusually strong period. Then I look at cash flow. Is the company actually generating cash? Then I look at debt. Is the balance sheet strong enough to handle difficult economic conditions? Next comes valuation. Even if I love the company, I don't automatically buy it. I compare its valuation with its historical range, its competitors, and my expectations for future growth. Then I look for its competitive advantage. And finally, I write down the biggest reasons the investment could go wrong. Only after going through all of that would I even consider buying. Notice something? I never started with the stock chart. I started with the business. That's a major difference. What about dividend stocks? Now, because we're talking about Canadian investing, there's another topic beginners often focus on. Dividends. A dividend can be an important part of an investment strategy. But I don't want you to make this mistake. It's paying a huge dividend, so it must be a great stock. Not necessarily. A very high dividend yield can sometimes be a warning sign. The share price may have fallen dramatically. The company's earnings may be under pressure. Or the dividend may simply not be sustainable. So instead of asking only, how much is the dividend? I ask, can this company realistically afford to keep paying it? That's a much better question. And remember, dividends aren't the only way investors can potentially earn returns. Capital appreciation matters too. The important thing is understanding the entire investment, not just one attractive number. What I would do as a beginner. If I were starting from scratch today, I wouldn't try to find 50 stocks. I'd start with a small watch list. Maybe 5 to 10 companies. And for each one, I'd write down. What does the company do? How does it make money? Is revenue growing? Are earnings healthy? Is cash flow strong? How much debt does it have? What is the valuation? What is the competitive advantage? What are the biggest risks? And finally, why do I want to own this company? If you can answer those questions clearly, you're already thinking much more like an investor and much less like someone simply chasing stock prices. One important Canadian reminder. And because you're investing in Canada, don't forget that where you hold your investments matters too. Depending on your situation, accounts such as a TFSA, RRSP, or FHSA can have different tax rules and purposes. So picking a good stock is only one part of the bigger picture. You also need to think about your goals, time horizon, risk tolerance, diversification, and the type of account you're using. The best investment strategy isn't necessarily the one with the most exciting stock. It's the one you can understand, stick with, and manage responsibly over the long term. Final takeaway. So if you remember nothing else from this video, remember these questions. Do I understand the business? Is the business actually growing? Does it generate healthy cash flow? Can it handle its debt? Am I paying a reasonable price? Does the company have a durable competitive advantage? Do I understand the major risks? And finally, can I explain in simple words why I want to own this company? If the answer to those questions is yes, you've done something much more valuable than simply finding a stock someone says is about to explode. You've started thinking like a long-term investor. And that's the goal. If this video helped you understand stock picking in a simpler way, hit the like button. It tells me you want more practical Canadian investing content like this. And if you're building your wealth in Canada and want more videos about investing, taxes, TFSAs, RSPs, and smart money decisions, subscribe to the channel. And here's my question for you. What's the hardest part of picking a stock? Knowing what to look for, understanding the numbers, or knowing when to buy? Let me know in the comments. I'll see you in the next one.